we have worse demographics. So back then the United States had a structural trade surplus. Now we have a structural trade deficit. So we look more like the UK looked in the 1940s
Hmm.
here in 2020s America, which, what happened to the UK after the next, 80 years was not catastrophic, but it was less prosperous than what happened in the United States. Let's put it like that.
Absolutely.
Um, and, as you said, I am bullish on energy because, we've not done enough investment in there, in my view, and kind of my quantified analysis. I think geopolitics are going to be messier over the next 30 years than they have been over the prior 30 years.
Hmm.
And a problem is that these things, this goes back to my point about nonlinear and like the challenge of long-term predictions, because, for example, sovereign debt bubbles feed on, they contribute to geopolitical conflicts and wars, and geopolitical conflicts and wars contribute to sovereign debt crises.
Yeah.
So it's like this feedback loop. Chaos leads to more chaos until it gets chaotic enough that some order emerges from it. That leads to more order. But then that eventually, gets stagnant and concentrated and leads to chaos, which then leads to more chaos. And I think we're in the deconstruction of the order phase. We're in the shifting toward chaos, fourth turning type of environment, which, it sounds like doomerism, but I just think it's important to kind of, that's where knowing history is important, because if you know those trends and enough people know those trends, then ideally you can avoid the worst scenarios and instead get the least bad scenarios, so that whatever emerged on the other side of that is, decent instead of horrific.
In this insightful snippet from Lyn Alden's analysis, we're confronted with the stark reality of a potential sovereign debt crisis looming over the global economy. Drawing parallels to historical patterns, Alden warns that geopolitical conflicts, coupled with structural trade deficits akin to those faced by the UK in the 1940s, could lead to a chaotic feedback loop. As economies shift towards instability, Alden suggests a diversified portfolio strategy, emphasizing the inclusion of assets like energy, gold, and Bitcoin to navigate potential inflationary environments.
But I think even in the context of fiscal dominance, you still have cycles. It's just that those cycles look a little bit different. They have some of those emerging market characteristics. So sometimes in recessions in emerging markets, sometimes you don't necessarily get high unemployment, but instead it's just the cost of everything is higher, right? So groceries, there's people are still employed, but their salaries buy less groceries, less energy,
Yep.
and things like that. And so I think you could see some of that. Um, you know, I think to the extent that we would get an unemployment spike, it'd be more like, say, the 2001 recession, for example, which was actually a pretty low unemployment spike relative to the recessions around it. Um,
Because
Even
it
though
mostly
obviously,
hit several, I mean, specific sectors, right?
yeah, it hit certain sectors, and it just overall was less severe. In addition, I mean, when you look at what happened during the pandemic, you had a lot of older workers retire and then not come back into the labor force. And so you kind of permanently tightened the labor force to some extent. Um, and so I think the variables to watch there, one is various types of immigration. They're a factor on employment. And then two, I guess if I think of, my base case is not very high unemployment. Um, but if I think of what could challenge that thesis, I try to look what are the tail scenarios. For example, if AI displaces jobs more quickly than my base
Sure.
case, then you could have something that's unrelated to macroeconomics contributing to unemployment that would deviate from how from that macroeconomic lens, right? So I look for variables like that can influence the outlook. So if we put AI aside for a second, for example, I would not expect huge unemployment, even though we could see an uptick. And then even people that are employed are finding that just their salaries are maybe not keeping up with their real cost of living. For example, with high interest rates and still high prices, it's the number of hours you have to work to afford a down payment and mortgage payments now, if you're a younger new buyer for a house, is pretty high. And that feels bad even
Oh,
if
it's
they're
crazy.
employed. Yeah.
Yeah.
And so I think that's the type of recession, or type of, maybe not even recession, but type of economic scenario we can be in, where it might not even show up like a recession in some of the numbers, but if you're on the wrong side of some of these trends, it feels really rough. If you already own your house, if you have a low fixed rate mortgage, you're kind of like the economy's fine. Why, that's why like we see these headlines, some of the papers that are like, the economy's fine. Why are people complaining, right?
Right.
And it's because the people writing those articles are often in the position where it's fine for them. Next, it's
Yeah.
sector specific, demographic specific, and I think that contributes to frustrations. And so from a portfolio perspective, when we look at the history of the 60/40 portfolio, it often performs poorly, especially in real terms, but even to some extent in nominal terms, depending on the severity, during inflationary decades. So in the modern kind of oil age, let's put it, the 1910s, the 1940s, the 1970s, and the 2000s were inflationary decades, especially in terms of energy prices, but then usually in terms of other prices as well. Um, and so in those decades, invariably, the stocks and bonds collectively did not do particularly well. And so in those environments, even if you still hold equities and bonds, you generally want to have another pillar of assets that do better in those more inflationary or stagflationary environments. And that's generally a mix of energy producers, gold, certain other commodity producers, maybe shorter duration treasuries or tips in the modern era, Bitcoin perhaps. Those types of assets in that third portfolio slice historically do better in those inflationary environments. And so even if you're not sure that inflation is here to stay, if you think there's some risk that inflation's here to stay, then having that more balanced kind of three-part portfolio can make a lot of sense compared to only stocks and bonds, which is very much geared toward the expectation of structural disinflationary growth. That's where that portfolio does best. Whereas in any other kind of scenario, especially in an international context, having that other slice is pretty good for the overall portfolio.
Continuing the discussion, Lyn Alden delves deeper into crafting a robust investment strategy tailored for potential inflationary environments. She advocates for a diversified approach, steering away from traditional bonds towards assets like short-duration bonds, gold, and energy producers. Emphasizing the importance of balancing one's portfolio with assets resilient to inflation, Alden suggests allocating a significant portion to pro-inflation assets, including Bitcoin for its high volatility profile. She underscores the need for investors to monitor their portfolio actively and adapt to shifting economic landscapes.
So yeah, for me, it's bigger than that. So let's say my own age category, I might have otherwise been, say, 80% stocks, 20% bonds. But what I would generally do is say, well, instead of bonds, I'm going to have, say, short duration bonds plus gold. And then for my 80% equity slice, I'm going to make sure that some significant percentage of that is in energy producers or other of these kind of, pro-inflation types of
Yeah.
assets, as well as maybe taking a slice and putting it into Bitcoin, right? For that, because it's got that high volatility profile. And so it ends up, for me, it ends up being something like, 20 to 30% of the portfolio or more is geared toward this scenario. And but that can obviously vary based on someone's volatility tolerance, how active they want to be with their, watching their portfolio. But basically, if most of the assets in your portfolio prefer disinflationary growth, you want to protect against the scenario of higher inflation, pressures on margins, pressures on real economic growth because of those higher input costs or some of those base things. And so you want to have exposure to some of those base things or exposure to some of the hard monies that people flee to if bonds are not seen as a good real return asset. So businesses often hold up better than bonds, but there's different types. So for example, if you look at the 1970s, often the way this works out is after a long disinflationary period, the stocks that are at the top of the stock indices are ones that really do well during disinflationary growth, like the big high valued growth companies.
Right.
And they're often the least well prepared to enter a more inflationary or stagflationary environment. Whereas the companies that have been doing poorly, the energy companies, the commodity producers, the certain types of value stocks, they're the ones that have done poorly. And so they're a small percentage of the market cap weighting. And so how equities do in that environment depends on one, as you pointed out, ideally you want to have low long-term debt You want to have either readjusting cash assets or income streams that are readily increasable as just nominal money supply and inflation go up over time. You want to have decent pricing power, so you're able to push those costs onto your customers as quickly as they're coming in the door. Um, and then you want to buy that asset at not too high of an initial starting valuation, because even if the business does well, if interest rates go up and people reevaluate the valuation of those equities, it could offset the performance. So, for example, a lot of the stocks, that they called it the Nifty 50, like the biggest 50 blue chip stocks in the U.S. back in the 1960s.
Mhm.
If you look at their performance by the time you got to the 80s, most of their fundamental performance was amazing. They continued growing, they did well. But when people were buying them at 30, 40, 50 times earnings, and by the end of that period, interest rates are higher. Now they're down to 15 times earnings. If you double your earnings but you cut your valuation in half, you went
You go
nowhere.
nowhere, yeah. Yeah.
And that's that we have to watch out for with some of these companies, where it's not just how the underlying fundamentals do, it's what do people pay for those fundamentals. So I generally find, for example, I want to find a company that can pass most of its cost inputs onto its customers. It basically decent pricing power, decent growth, generating positive free cash flow, and then I'm buying it at a dividend adjusted PEG ratio of below 2. So PEG ratio is price to earnings over growth, right? So if a stock is growing earnings at 10% a year, maybe I want to pay up to 20 times earnings for it. That'd be 20 divided by 10, which is a PEG ratio of 2. But then I also incorporate the dividend yield. So, for example, if a company's growing earnings at 8% a year, but is paying a 2% dividend along the way, that's a combination of about 10%. If I take that dividend and reinvest it into more shares, for example, then
Mhm.
then my personal growth rate would be about 10%. So again, maybe I pay something like 20 times earnings for that. It'll depend on what the prevailing discount rate is. What can I get on bonds, for example? What would other people look at this compared to bonds? How would it stand out to them? Is the equity risk premium decent enough? There are some kind of rules of thumb you can do, and you're basically saying, compared to bonds, what is a reasonable equity risk premium that I can get? And ideally, you want that to be fairly high and with a fairly high quality business, it's fairly hard to find these days, but they do exist. And just among large cap U.S. equities, that's the most crowded space right now. So that's where valuations tend to be on the higher end.
Today's discussion with Lyn Alden has shed light on crucial insights for navigating uncertain economic landscapes. From the implications of shifting demographics to the intricate interplay between geopolitics and sovereign debt, Alden's analysis provides valuable guidance for investors. Her emphasis on building diversified portfolios, including assets like energy, gold, and Bitcoin, underscores the importance of being prepared for potential inflationary environments. Remember, staying informed and adaptable is key in today's dynamic markets. If you found this discussion informative, don't forget to hit the subscribe button, give us a thumbs up, and share your thoughts in the comments below.